Hi everyone, hope you're all doing well, and today we'll talk about 10 stocks that I might buy. Now I'm not going to lie, there's more than 10 stocks on this list, but it's not as catchy as saying there's 10 stocks to buy. So yeah, we are going for a bit more of the catchy title. I think overall there's 12 on this list. Some stocks that I own, some stocks that I don't own, and I'm going to let you on a bit of a secret. If you're on the Patreon, you'll know this, but there is one of these stocks on this list that I have bought, and I probably do a full video on it at some point and do a bit of a deep dive on why I bought that stock. But until then, if you're not on the Patreon, you'll have to have a guess and think which one it could be. But yeah, if you're on the Patreon, there was also this video on here which was a Q&A special, so if you are a Patreon member, go check that out. And if you do want to start investing, there's some links to some brokers like Free Trade and Stake in the description. Join through there and you get a free share as well. But without wasting any more time, we'll get stuck onto this one that you guys voted for 2 days ago and talk about some of the stocks that I'm looking to buy. Some are a little bit closer to buys than other ones at the moment. When I do get onto the stock, I'll kind of say how close I am to buying that one individually. So yeah, hope the video is useful. So, number one, the only UK stock on this list, which is ASOS. So I am considering buying some shares in ASOS. I was, a while ago, this dip here really interested me. If you watch the free UK stocks to buy, I did do a bit of a full deep dive into this one. And yeah, I basically said, you know, look, when it was down 31%, I was very tempted. The only big thing that put me off is that I already have Boohoo, and then after the 30% dip, it went then bang, it went down 45%, and even higher if you go from 52-week highs. So yeah, to say that this is, you know, quite a good UK stock, you know, 3 billion, quite a decent size for a UK company, trading at a P of 17. Obviously, that's quite cheap considering that this is a company that has absolutely amazing balance sheet, very good profit growth. Historically, very good revenue growth, you know, normally grows about, you know, 10 to 20%. So for a bit of a growth company really on the UK side to be at 17 P ratio does seem really cheap, you know, it's nearly half off its 52 highs, for example. So yeah, I'm very, very tempted to start pulling the trigger on this one. The only thing that's kind of holding me off at the moment is you'll just see this. It's just this downtrend here, you know, it's a very ugly downtrend and it could carry on going for a little bit. And the worst thing I want to do is kind of try catch a falling knife. So I'm trying to hope that it stops bleeding as much and just kind of consolidates for a bit, and then I might go buy. And I also want to be very careful because the thing is, this kind of got spooked off its earnings when they said like we've seen a softening in the sales, and I think until we get actual earnings and we see how much that softening is, it could be very volatile in between there as well. So I'm still very undecided when to kind of pull the trigger, but at these sort of valuations, it's just getting more and more tempting. So it could be pretty much any day that kind of gets pulled trigger on that one. But that is the only UK stock and a stock that I don't own on the list. And the next two stocks that I don't own on the list, and they're very similar stocks. So the first one is Zillow. So I have been considering Zillow recently. The only reason why I'm not really bought Zillow or the next stock is because they are to do with real estate, and obviously real estate in the US. Now, being from the UK, I feel like when you are in that country, you can kind of feel things changing before the numbers actually reflect that. And you know, when you have like boots on the ground, you have a bit more of a better feeling of how things are going. And I feel like because it's the housing market in the US, because I'm not there, I just feel like I just don't have that in touch what I would like to be on this investment. Like compared to like Taylor Wimpey and Barratt Developments, which are UK house builder stocks I own, I kind of understand how the UK housing market's going. We've been in the UK, a bit harder I feel with it being the US, and that's the only thing that's kind of put me off buying them at the moment, is that I don't have that kind of boots on the ground really. But overall, like this stock in particular, as well as the last one, you know, this was a $200 stock, fallen all the way down to $92 at the moment. It's actually squeezing a little bit of a profit. The balance sheet's not too bad. If you look at the price to sales ratio for the growth that this is going to put in, it is very dirt cheap. And also it ties in with the next one, which once again is involved in real estate, which is Open Door. Had a bit of a dip recently. Originally came onto the stock market as a bit of a SPAC stock, and you can see here it went on an absolute crazy run. Was up at $35. Kind of reminds you a bit of Skills, doesn't it? And then it's had a bit of a reality check, and pretty much any SPAC related stock at the moment has had pretty much a rough 2021. They're just totally out of favour. SPACs are out of favour. and a lot of them are small market caps and they're out of favour. And yeah, you know, say that it was at this sort of valuation, then it's, you know, fallen back quite a bit. It is a little bit tempting to kind of pull the trigger on this one. This is actually a bit cheaper valuations than Zillow. It just loses a lot more money than Zillow. That's the only little bit different, I guess, with it. But yeah, both of these, I did a screener on Patreon the other day, if any of you guys are on Patreon and saw that. But yeah, both of these stocks came up as massively undervalued. And yeah, the growth they're putting in and everything like that, very tempting. And Open Doors' last earnings as well were very impressive. So yeah, still very undecided on Zillow and Open Door. I just don't know if I can commit to that sort of industry yet, and that's the kind of big thing holding me back on them two stocks. So yeah, going on to the first stock that I actually own on this list, which is Planet 13. So in my opinion, this is the best Mary Jane play in that space, if you know what I'm on about here. Yeah, these guys had very good earnings as well. Opened up their new superstore as well. The growth was impressive. I think it was 100% revenue growth off the top of my head. And yeah, it's had a bit of a pullback recently. You can see here a little bit of a downtrend, but when you consider it has been on a pretty good run last year, it's probably due a bit of a calming phase. But yeah, this is my favourite MJ play in here because it ties in so many things, and the stores and a bit more of the experience, and just the whole venue is pretty much, you know, if you ever see the venues, are absolutely amazing. So yeah, I am considering buying this one. I think it's the one that I'm down most on this list actually. So it means averaging in a little bit. Still has a little bit high risk because of the industry that it's in. But I am considering picking up a few more shares in this one. This is probably like one of the higher ones up on my list right now. And next up, Corsair. So I'm actually break even on Corsair, and my position is kind of nearly fully built. I could probably buy a little bit more in this one. If I buy a bit more in this one, it would come very close to being a top 3 position, which I can see happening because in my opinion, Corsair is probably one of the easy money stocks on the stock market right now. You know, every so often I kind of get asked, you know, what's my next easy money stock, and you know, every so often I say there's an easy money stock, and I think the last one was GNOG. I think GNOG was the last one that I said is, you know, easy money at these sort of valuations, and then within kind of, you know, 3-4 months, I think that obviously got bought out by DraftKings, and I'd say that Corsair is pretty much getting very close to the one now that I would call easy money. You know, it's got a really good growth, very good TAM, good profit revenue growth, trading down at an 18p ratio, a 13 forward P ratio. I think it's forecast to only grow a couple of percent next year. I can't even remember how much it is. I think it's like 3%, even though it's just grown 25% this year on very hard comps from last year as well. And yeah, even with very tough logistic problems as well, trying to get components, it's still smashing earnings. So yeah, Corsair I'm very, very bullish on this company. I've considered making it a top 3 position. I've even considered making it my biggest position, which says a lot because you guys know that DraftKings is, like, for me, like, you know, really high up there, and I've really considered it. I do really like this one, and I'm a bit undecided if I'm going to buy because I'm break even, and if I was to buy now, my position would be pretty much fully built, and then if it was to go down to say a 27, 26, 25, then I'd be like, oh, I don't really want to buy, and it'd be quite hard for me to carry on averaging up because of how much money I would have to put in to average up. So yeah, Corsair, I do want to buy. I'm just being very careful. You can see it has had that little bounce there a little bit over the last kind of, you know, month really. So yeah, that's why I'm not really bought too much at the moment, but I won't mind buying. So yeah, that's another one that I'm a little bit undecided on at the moment, but it's probably on this list the one that I'm most bullish on, and probably the one that I do really want to buy. It's just about timing it really, I guess. And that's coming from someone that always says don't try to time the market. Next up is Gang. So Gang has had a bit of a rough kind of couple of months. Well, not a couple of months, last couple of weeks. It's fallen down about 15%. But realistically, it's just been pretty flat. I mean, look how flat that is, pretty much for a year chart. You know, it is volatile, but you can see it's pretty much, you know, it generally moves like 5% on a day, but you can see here it's pretty much stayed in that sort of range. And you can see here, once again, apart from that little spike that we had in February, same again, it's just pretty much stayed in that kind of range at the moment. And the crazy thing really with Gang is, like, 8th of May is when it IPO'd. Obviously that's a year on, it's pretty much the same price. We're nearly getting on to a year and a half on now. And in this time, Gang's grown revenue over 100%. It could make profit, has an amazing balance sheet. It's acquired so many amazing new customers since that time of that IPO. And yeah, it's just flat. And when I was doing the screener the other day, this and Tattoo Chef as well were two stocks that personally for me, I see a lot of upside on. Like, I love Corsair. I think it's probably got 2-3x potential. And I think it's a very safe stock compared to a Gang or a Tattoo Chef. I think they have a little bit more risk because obviously they're a bit more early stage, a bit more growth, a bit more unprofitable, a bit more volatility. But when I look at Gang, like, I just can only see this succeeding. And the screener kind of pointed out how cheap this stock is and how cheap it is compared to the peers as well. And generally, like, looking at this, it's a 600 million market cap. You start talking 6 billion, that's a 10x. And can this stock get to a 6 billion? I think it can. I generally think this is this and potentially DraftKings, Tattoo Chef. Those are the 3 stocks in my portfolio that I can easily see. I'm not putting the pressure on them to do it. I'd be happy with, obviously I always invest for 100% return. Generally, I would hope a bit more with these. I'd probably hope a 3, 4, 5x return with them. But, if I look back on this portfolio in 3, 4 years, maybe even a bit more than that, 3, 4 years time, I could see these being 10x stocks. And Gang at $15 for me is a bargain. And there's so many times I've gone, I can't make Gang a big position in my portfolio. But the longer it stays at $15 and it grows at how it's growing, I keep going, this could be a big position of mine. And it is getting there. It is getting quite high up there. But I mean, top 5 positions potentially. But yeah, I think Gang is just very, very cheap at these sort of prices. Next up, 2 Chinese companies. So I guess you'll probably be able to know which the next one is. I mean, Alibaba, $159 now. And then Huya, $9 now. I mean, what can I say about these? Obviously, you guys know there's so much negativity out there to China right now. And they're just so cheap prices. In my opinion, very good companies, fundamentally very good. And I think it's just one of those times like 2018, like 2015, there's just a lot of China bashing going on at the moment. So much negativity priced in. And it's just a question of how long it's going to go on for, because when it kind of goes away, these stocks will go back up in value. But while there's a lot of this, FUD out there that is being pushed by a lot of the media, they'll just stay at these prices and they could go a little bit lower. So I'm being a little bit careful with buying these ones as well. Obviously, even though I do like Chinese stocks, I don't like to commit too much of the portfolio to them. But, you look at these companies at these sort of prices and you just think, I'll just have a little bit, one more nibble at these sort of prices. So I am kind of considering buying Alibaba and Huya. If this was any other company, I would have been buying these really, really heavy. But just because they're a Chinese stock, I'm just being very careful because, you never know where the bottom of these stocks are going to be. Next kind of month we might be talking about Alibaba at 140. So, just being careful about catching a falling knife on particularly these two. So I am thinking about buying them, but they're a little bit lower down the list at the moment. I'm just gently adding into them. I'm not being very aggressive at the moment with them. Next up, Hims and Hers. So I wasn't really interested in this stock a while ago. Obviously it was a SPAC stock. It just shot up in value and it went all the way up to $23 and even around here, $14. I mean, I was kind of considering, I had a look at this one a while ago and I was considering Teledoc as well, and I compared, Hims and Hers at like, 14, 15, 16, that sort of range to Teledoc, and I think I like Teledoc a bit more. The difference is that Hims has lost half its value since I last looked at it. It's gone from 13, 14, even $16 I think when I started looking at it on this big drop. Even since then, it's lost nearly half its value and sitting down about 1.7 billion market cap. Thought I'd have a bit of a look into it. Had a look into it. Very, very impressed with the company. And I think at $8, I like it more than Teledoc. It's growing very well. I could not believe that this company was only founded in 2017 and he's putting in like 250 million revenue growth. Bit more, bit unlike T-Doc, it's a bit more international based. It's a little bit more business to consumer rather than business to business. It's expanding internationally, and as well as that, it's actually putting in really good growth this year. I think it started the year off only like forecasting like 30% growth or something, and we're all the way up at 70% growth right now. And that's very impressive because you consider T-Doc's struggling for a bit of growth. It's only really the Vongo merger that's really saving it a little bit at the moment. If it wasn't for that, T-Doc's growth wouldn't be that impressive. But hims and hers, they've made a few acquisitions, but them acquisitions haven't played into the financials yet. And the financials they're putting out are very strong, gross margins of like 78%. And this is if it wasn't so much for general and admin costs and marketing costs, this could quite easily be a profitable company. So yeah, this is very, very interesting to me, and I've not bought a new company for a while. So yeah, this is one that I don't own, but could consider buying this one. And next up, I could have bought it. And next up is Beyond Me. So Beyond Me is $109, or it's just changed to $110. Had a bit of a rough kind of couple of months really. I mean, it had a little bit of a bounce up here, and then since then been downtrending, obviously 30%. It's generally a volatile stock. It brought earnings out. I actually talked about it a little bit on Patreon. I was just saying, earnings were fantastic, but the stock price just going down and down. And for me, this is just a classic case of the share price isn't reflecting how the company's performing. And eventually there'll be a point where Wall Street wakes up and go, oh, Beyond Meat are back doing really good financials. But what you'll see right now is actually the financials are just suddenly going very well at the moment. My position on Beyond Meat, I'm not going to lie, is pretty much nearly fully built. I mean, I started buying this in November. Normally takes me around 6 to 12 months to kind of fully build a position. So obviously we are kind of getting towards a year now on from Beyond Meat. So yeah, I'm pretty nearly fully built on this. I could probably afford to buy probably one more time, but I'm only down about 5% on the position. So for me to buy it, I'd like to be a bit more down on it than what I am at the moment. It's the same for Gang really as well, and that's why I've not really bought them two at that much at the moment. It's because I've had them for nearly a year now, and I'm pretty much nearly fully built. And if I am going to buy, I need to be down a fair bit to kind of buy, to pull that average lower to justify me buying really. So yeah, I mean I might buy this one, but I'm just being very careful because I think I've got one more bullet to shoot, and I want to make sure it's the right time and at the right place. So yeah. I do really like it at these sort of prices, but that's why I've not potentially bought at the moment. And Skills, very much the same for Skills. Skills comes onto the category of I'm happy with my position size at the moment. I think I'm down about 20% on this one at the moment. Skills has been a crazy year. This is, I've said a lot of stocks are volatile, but this takes the crown of volatility. I mean, look at that. I mean, it's just, SPAC. It was a SPAC, it boomed up, it fell off the cliff. Never thought it would go to these sort of prices again. Started buying, thought, here we go, took a bit of profit, went down again, went, whoa, it's fallen off a cliff again. Started going up, bought, started going up again, sold again, or took a little bit of profit, and then it's come back down again, back at $10. And it just, small caps are out of favour, SPACs are out of favour. This comes under both of them. And yeah, I mean at $10, I'm a big fan. I'm being very cautious because obviously it has that little bit more higher risk to it because it is an unprofitable company, and that's why, especially with the money that Skills does burn through, it can't be a big position in my portfolio. But I'm a big fan of it, and like I said, I'm kind of fully built on it really. So if I'm going to buy a bit more Skills, it has to be at the right sort of prices. And yeah, I mean $10 is very tempting. I mean I never thought it would go under like $16, so to be back down at 10 is kind of crazy. But yeah, I mean I'm still happy because the company's performing really good. It's got the NFL deal coming out as well. Financially, it's performed very well. Since here it's grown 100% as well. What you've got to consider. So yeah, that's kind of where I'm at with Skills. Still a happy shareholder though at the moment. And the last one, which is Callaway Golf. So yeah, I kind of talked about this. I think it was on Monday. So I won't spend too long on it, but yeah, kind of thought it never would come back down. But the last few months, for no reason, very good earnings, kind of pulled back a little bit. Same again, I've kind of got I've built like an average position on this one. I could buy more, but if I'm going to buy more, then I need to be averaging down a fair bit to kind of justify putting that money in. So for Callaway Golf, it needs to come down to probably like $25, $24 before I consider buying anymore. And yeah, you'll kind of see that's a common theme with a lot of these stocks at the moment. You know, I'm very interested in buying them, and that's why I might buy them. But there's quite a few that just need to go lower for me to buy them. Apart from one or two are very tempting at the prices they are at. And like I say, there is one stock on here that I have bought. I tried to not give it away, but I feel like I have done, which I will probably talk about in a few days' time, and my kind of bull case on it, do a full video on it, and kind of my plans, you know, where I see it going, where I'd potentially buy more and everything like that. But yeah, hope the video was useful for any of you guys who want to see it anyway. If it was, hit the like button. If you're new and you found this video helpful, subscribe, it is free, and I'll see you on the next video. Post some comments, let me know what you see on the next video. Maybe I'll kind of reveal my new stock in my next video. I'll see, I'll have a think about it. But yeah, anyway, see you in a bit, guys.